When Community Health Systems spun off Quorum Health Corporation in April 2016, they marketed it as a fresh start for rural healthcare in America. 38 hospitals across 29 states would finally have dedicated leadership focused on serving underserved communities. The newly independent company traded on the New York Stock Exchange under the symbol QHC, with a market capitalization of nearly $800 million. What investors and patients didn't know was that they were witnessing the setup for the largest hospital bankruptcy in United States history, orchestrated through a web of financial crimes that would leave dozens of communities without emergency care, while executives secretly enriched themselves through an elaborate shell company scheme. Michael Cullotta, Quorum's chief executive officer, and Thomas Miller, the chief financial officer, immediately began implementing what they called operational improvements, but what federal investigators would later identify as systematic asset stripping. Within months of the spinoff, Quorum began selling valuable real estate holdings to related entities at below-market prices, then leasing the same properties back at inflated rates. The Spring Hill Medical Center in Mobile, Alabama, was sold to a Cullotta-controlled entity for $12 million, despite independent appraisals valuing the property at over $20 million. The hospital then paid nearly $2 million annually in lease payments back to the same entity, creating a direct pipeline of cash from the struggling hospital system to executive bank accounts. The financial engineering became increasingly sophisticated as Quorum's public financial condition deteriorated. By 2017, the company reported losses of over $200 million, while simultaneously entering into management agreements with shell companies connected to senior executives. Miller established Meridian Healthcare Management through a series of Delaware corporations, which then received consulting contracts worth millions of dollars for services that were either duplicative of existing staff functions or never actually performed. Internal emails later obtained by federal prosecutors showed Miller directing subordinates to approve payments to Meridian for strategic planning services during the same periods when Quorum was laying off hundreds of employees and closing emergency departments due to budget constraints. The human cost of these financial crimes became apparent throughout 2018 and 2019 as rural communities lost their only healthcare providers. The Pioneer Community Hospital of Early in Blakely, Georgia, closed its doors permanently in April 2018, forcing residents to drive over 50 miles for emergency care. Within 6 months, 3 more Quorum facilities ceased operations, including the Pepperell Regional Hospital in Lindale, Georgia, and the Providence Hospital in Columbia, South Carolina. Federal bankruptcy documents revealed that while these hospitals claimed they couldn't afford basic medical equipment or nursing staff, Quorum had transferred over $40 million to executive-controlled entities through inflated service agreements and below-market asset sales. The closures created healthcare deserts affecting over 300,000 Americans, many of whom were elderly or suffered from chronic conditions requiring regular medical monitoring. The shell company network extended far beyond simple real estate transactions and consulting agreements. Cullotta and Miller created a complex web of interconnected entities designed to obscure the movement of funds and complicate any potential investigation. Through companies named Strategic Healthcare Partners, Regional Medical Solutions, and Community Health Ventures, they established contracts for everything from laundry services to medical equipment leasing. The Tyler County Hospital in Woodville, Texas, paid over $800,000 annually to Strategic Healthcare Partners for administrative services, despite the company having no full-time employees and sharing an address with Cullotta's personal financial advisor. When the hospital filed for closure in October 2019, it claimed assets of less than $2 million, while Strategic Healthcare Partners had received over $3 million in payments during the previous 18 months. Federal investigators uncovered the extent of the fraud through a whistleblower complaint filed by Sarah Henderson, a former Quorum vice president of finance who had been terminated after raising concerns about the shell company payments. Henderson's detailed documentation showed that executives had established a systematic process for draining cash from individual hospitals before declaring them financially unviable. The process began with transferring valuable assets to related entities, followed by loading the hospitals with service contracts to executive-controlled companies, and concluded with stripping remaining cash reserves through emergency management fees. The Fairfax Community Hospital in Oklahoma exemplified this pattern, losing over $15 million in asset value within 2 years while paying $7 million in fees to Cullata and Miller's various entities. The bankruptcy filing in April 2020 revealed the true scope of the financial devastation. Quorum listed assets of just over $100 million against liabilities exceeding $600 million, making it the largest hospital bankruptcy by debt load in American history. However, forensic accountants hired by the bankruptcy trustee discovered that the company should have had significantly more assets based on its 2016 starting position and subsequent revenue. Over $200 million in value had been transferred out of the company through the shell company network, while debt had been artificially inflated through related party transactions designed to benefit executives at the expense of creditors and patients. The criminal charges filed in September 2021 painted a picture of corporate executives treating rural hospitals as personal piggy banks, while communities lost access to life-saving medical care. Cullata was charged with conspiracy to commit wire fraud, money laundering, and bankruptcy fraud for his role in orchestrating the shell company scheme. Miller faced additional charges of securities fraud for making false statements to investors and auditors about the nature of the related party transactions. The indictment detailed how they had used encrypted messaging apps to coordinate the movement of funds and had deliberately structured transactions to avoid detection by auditors and board members. Federal prosecutors alleged that the executives had stolen over $60 million directly, while their actions had caused an additional $140 million in losses to investors, creditors, and Medicare. The investigation revealed that the fraud had extended to the very end of Quorum's operations, with executives continuing to loot the company even as bankruptcy became inevitable. In the final 6 months before filing, Cullata authorized $23 million in payments to shell companies for supposed restructuring services, while simultaneously negotiating the closure of 12 hospitals. Miller transferred ownership of valuable medical equipment to a newly created entity controlled by his wife, then had Quorum lease back the same equipment at rates that exceeded the original purchase price within 2 years. The bankruptcy trustee's report documented hundreds of similar transactions that served no business purpose other than to enrich executives, while ensuring that creditors and affected communities would recover nothing. The sentencing phase brought some measure of justice for the communities devastated by Quorum's collapse, though it could never restore the healthcare services lost forever. Cullata received a 15-year federal prison sentence and was ordered to pay $38 million in restitution. Miller was sentenced to 12 years and ordered to forfeit $22 million in assets traced to the fraud proceeds. However, the recovery efforts have returned less than 10% of the stolen funds, as much of the money was moved offshore or spent on luxury assets that depreciated significantly in value. Of the 38 hospitals that began as part of Quorum Health Corporation, only 8 continue to operate under new ownership, while the rest either closed permanently or were demolished. The communities affected by these closures continue to struggle with limited healthcare access, higher emergency response times, and the economic devastation that follows when a major employer suddenly disappears. The Quorum Health bankruptcy stands as a stark example of how corporate fraud can devastate essential public services while enriching the executives responsible for managing them. The case highlighted significant weaknesses in hospital oversight and bankruptcy law that allowed sophisticated criminals to exploit the complexity of healthcare finance for personal gain. Federal regulators have since implemented new reporting requirements for hospital ownership changes and related party transactions, while several states have created early warning systems designed to identify financially distressed hospitals before they reach the point of sudden closure. However, these reforms came too late for the hundreds of thousands of Americans who lost access to local health care when Quorum's executives chose personal enrichment over their duty to serve the communities that trusted them with their most vital needs.